If you like banks, like if you want to be invested in the financial sector, you should not be picking company. You don't want to say, okay, I'm going to buy a bank CD, I don't want to invest in Chase or Citibank or some other bank, Wells Fargo and so on. If you buy the bank sector, you will have all of this information, all of these different banks within the same exchange fund. So you're again spreading your risk, because 90% of the return comes from predicting and being in the right sector, not in the right stock. And so since I mentioned exchange traded funds, let's also talk about exchange traded funds. What are exchange traded funds? Exchange traded funds are very similar to mutual funds. The difference is, again, you still have a lot of people commingling their money, and you're buying a basket of stocks, right? Basket of companies, not just one stock, one company. The difference between mutual funds and exchange traded stocks is the fact that with mutual funds, you have an active management team. You have a money manager or a team of money managers who will make decisions as far as on a daily, weekly basis, what to buy, what to sell, and what to do. So there's much more actively, those are much more actively managed accounts. And as a result of that, the fees associated with mutual funds tend to be higher than the fees associated with exchange traded funds. Exchange traded funds are more passive investments. So you can buy the entire, for example, S&P 500 index or the Russell 1000 index or the EFA index, right? And when you buy those indices, because they're passively managed, you're just buying the index, right? Maybe there is some changes that happen every once in a while, but there is no active management. As a result of that, the fees are much, 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 much lower. The other thing that I really, really like about exchange traded funds as opposed to mutual funds is that exchange traded funds are traded almost like stocks, which means you can buy and sell during the stock market, period, during a day, as opposed to mutual fund. Even if the market's going down and you decide, oh my God, I want to sell my money, you still, if you put in an order to sell or buy a mutual fund, that order doesn't get executed until the close of the market at 4 p.m. As opposed to when you're buying an exchange traded fund, you can actually, it functions almost like a stock in terms of the trading ability for that. So I hope that makes sense to you. So those are kind of the basic types of investments. Of course, we have also bonds, which are, there are different bonds. There are government issued bonds, there are corporation issued bonds, and so on and so forth. And think of bonds as debt instruments, right? So if I am the government or I am a corporation and I want to raise some money, I'm going to issue bonds where people can buy those bonds, and I will give them interest on the money that they have lent to me on a typically it's on a semi-annual basis, so every 6 months. And then usually bonds have a period of terms, like let's say you can have a 10-year bond or a 30-year bond or a 5-year bond and so on. So bonds are considered fixed income investments as opposed to stocks are, stock investments. So fixed incomes versus equity investments. So stocks are equity investments and bonds are fixed income investments. So those are the basic types of investments, obviously, when it comes to capital markets, but then you also have your real estate investments. Now, the real estate investments can be done in 2 different ways. You can, as an individual, you can go ahead and purchase real estate yourself, which is not an easy thing to do because you have to have saved money. You have to have at least 10 or 20% down payment to purchase a real estate. Then you have, typically people will go to the bank and ask for a mortgage for the rest of the payment to purchase the real estate. And then obviously you need to have good credit in order for the bank, and have to have decent income, and you have to go through this process of vetting process in order for the bank to decide if they're going to lend you the money for this real estate. But nonetheless, that is one type of an investment, and a lot of people are able to do those kinds of investments. And And I really think that's a perfect way to have more diversification in your overall assets. So yes, if you can afford and you can do that, then by all means consider doing that. Although it comes with a lot of its own issues, because if you have an individual house or a commercial house, then you have to also maintain it there. Obviously it's not easy to make money. You have to consider all the work that comes along with owning an individual real estate, as opposed to buying real estate funds, REITs. They're called REITs, real estate exchange traded funds, where again, similar to mutual funds, you co-mingle your money with many other people who are interested in investing in real estate, and they can get similar type of returns with a lot less risk, obviously, and a lot more liquidity. Because with REITs, you can buy and sell your REITs, they're liquid, as opposed to a house. You buy a house, number one, it costs a lot of money to go through the closing costs and have attorney's fees and many other fees that are associated with purchasing a house and also selling a house. Those are not liquid investments, as opposed to REITs, which are very liquid type of investments. So I think those are the basics. Obviously, there are many other ways to invest, but for the purposes of today's lesson, staying with basic theme, those are the things that I want you to think about.